3. You will not need to watch ICT. You will not need to know what I think or my opinion. But narrative is understanding how they're going to deliver it. Who? The market maker. The algorithm. If they're going to be a manual intervention, which I believe non-farm payroll yesterday was. That was an absolute shit show. Like that was a beautiful run lower, but that's what you are trying to avoid. You don't want to be in that if you're trying to go long and you get caught in that on the wrong side. You try to do the bracket the market. Here's a buy stop, here's a sell stop, and then there it is. Sometimes you can get whipsawed and it'll tag you both directions. And that's the part about non-farm payroll that prevents me from wanting to trade it, because I don't have anything in my repertoire to know when they will do that one-sidedness, like almost like a CPI. Like you watch me get wrecked with my opinion on CPI when I publicly thought this is what I would like to see happen, but I can't push a button, but this is what I'm subscribing to. And then just right on up, it just shot straight up. Well, yesterday, I told you where I felt the market was going to go to. It was going to draw down first. And it's going to reach towards what direction? The sell side. Okay. So that's your bias. The bias is it's going to go down, but you can't take any entry yet because non-farm payroll is highly volatile. So you got to let that market hit, run, and then see what's left in its wake. Where did it leave opportunities to come back and either run for stops or go back and reprice to where there's an inefficiency? And I showed you that in the review yesterday. Okay. I sent a tweet out, said, what do you see on the hourly chart? Okay. I wanted you to take a look at your hourly chart and see what you saw. And obviously you can see the weekly opening, that gap. And also there was a volume imbalance from the daily chart, extend that through, and it went down to the buy side imbalance, sell side efficiency discount low. So all of that was mentioned in the little review that I did on Twitter. So go back and watch that. It's a real short little 2-minute video. But I mentioned that in a second tweet, I said, here's the buy side, here's the sell side. Both are likely to be swept. Now, if I co-signed first that sell side's my interest, that's my bias. I'm looking for a move to go lower. And it's going to go, in my mind, the largest move is going to be where? Down. It's going to seek the sell side. Why? Look what it's done all week. It just kept pressing higher, up into an imbalance on the daily chart. Once it's done that, then there was a shift in market structure. You saw me sell short in the middle of the week and get the biggest portion of the move there with the $40,000 example from beginning to end. I didn't have some off-screen shit, okay, over leveraging without a stop loss. As my example, I walked the whole fucking thing with no partial. So you saw the big move of the week. You saw me point where I thought that the non-farm payroll would aim for, but I also mentioned that both of those liquidity pools would be swept. So it created that sell side imbalance, sell side imbalance, buy side inefficiency, or SIBI, big one-sidedness move lower. Okay. Then once the market had that report in its hands, and it came down to a discount low relative to that imbalance I showed on the hourly chart, then you watch and see if there's a shift in market structure, as I outlined in that short little review on Twitter. Then that imbalance, I grade that. Okay, I get a full measurement of that, and I'm bracketing it off where 20 to 25%, 50%, 75 to 80%, and all the way up to a complete repricing of that full move down. That's grading a price swing. It's not used simply just in imbalances like that. I use it also when I'm doing price runs that are not really running back up into a SIBI or running down into a BISI, buy side imbalance, sell side efficiency. And I know some of this is going to go right over your fucking head, and I know, but this is why you got to keep showing up every day. There's no ads here. I'm not getting paid to do this. I do this because I love it. I absolutely want to see you fucking crush it. And I know you can. You don't know you can yet, but I know if you keep showing up, you're going to learn how to do this shit, and you're going to be a fucking menace. You're going to be making fucking money, and you're going to know everything what you're supposed to be doing and what not to do. And these discussions is what gets you there. Not the, give me real quick, bullet point videos, learn ICT in 5 minutes. No. So once I grade those runs, either it's a price swing that I'm trading back up into, or it's just a trend, I'll grade those price swings where I think it's going to go. How do I do that? I have to know where it's likely to reach for. So it takes us back to the draw on liquidity. And that is where narrative comes in play. So if I told you early in the morning that both sides of that condition of sell side and buy side would be swept, okay, you're going to hear my stomach because I'm fasting. But the idea of that first run down, nobody would have expected to see it come all the way back up and take out those relative equal highs. But you got a tweet from me saying that they're going to take both sides of those. But I told you my opinion where it's going to go first, the sell side. So once it ran down to where a logical level of order flow should come in at a deep discount on that hourly buy side unbalanced, sell side inefficiency being repriced to, and then returning to the weekly open gap where we take that and we extend that through the week. So we had that one time pass through on the hourly chart where there's a green candle going up through that gap that opened up on the week. And then I said, okay, the way a market is balanced, okay, the way it becomes balanced is where if there's a gap, which is a real liquidity void, there's no trading at all, no printing by any candle, wick, or body. That is a liquidity void. There is no liquidity there. And folks, if you're doing videos and such and you're trying to teach my shit, I'm going to correct you here too. When there's an imbalance, okay, the market's not going back up there because there's liquidity. There is no liquidity there. There's none. So stop saying there's liquidity up here. There's no fucking liquidity. The algorithm is repricing up there to engineer and invite liquidity into the marketplace because buyers will chase that. So you're being schooled today. But I grade the price swing by knowing where it's likely to go. So the first premium array that I'm interested in was going right back up to the closure of that SIBI. If it goes beyond that, what will be the next thing? The relative equal highs I gave you in a tweet where buy side liquidity was residing. So I had to be at Bayview, John Hopkins, with my oldest son for a procedure, and I couldn't manage the trade or worry with it. So I just moved the stop loss up thinking, okay, it's either going to run or it's going to stop me out. Either one I'm fine with. And it just happened to come back and stop me out before I left the house to go meet him at Bayview. So when I know what I'm looking for and when you're going to know where the next draw on liquidity is, that's why you have to spend more time knowing that stuff. Because entry patterns are easy. When every time I do a trade and I'm showing you examples of it, that's not cherry picked. That's me simply doing what I do. And you see that I know what I'm doing is right out of the notes and the teachings I give you. Every single one of my pyramid entries are an individual entry opportunity that you could have taken too. You don't need the initial entries that I'm doing. I'm just showing you everything that I see, just to, by contrast, showing you that nobody else out there knows smart money concepts like I do. They can't do it. They cannot do it. And these are just low threshold shit. This is little stuff. 2023, I'm going to fucking blow your fucking socks off. But you start with this easy stuff, knowing where the market's likely to go, knowing that wherever the market is right now, or where it recently came from a low, if it's bullish and you think it's going to go up 100 handles on S&P, then you take a fib and you extend it from the low it just recently made that you don't have to necessarily be in along from. Or if you're lucky to know what you're looking for and you were in front of the charts as it happened and you bought that low, then you take your fib and you extend it up and you look for 25, 50, 75 and terminus. Terminus is the draw on liquidity, where it goes to. Inception of the move is the low in this case. So you're looking for these areas where what's going to form? Fair value gaps, order blocks, stop runs. They're going to occur at the 25, the 50, and 50 is going to consolidate because it's equilibrium. Look at what I showed you last night and think about what I taught in month 1 content of the core content, where I talk about the 4 stages of how markets deliver price. The algorithm does 4 major things. When does it consolidate, ICT? I just went through answering questions on my forum. I'm not going to give you those answers here, but I'm giving you clues in knowing how to know where consolidations occur. Consolidations in intraday price action will occur around equilibrium. What's equilibrium? The 50% of that SIBI. It doesn't have to go up there and completely close in that one big drop. It doesn't have to do that. That's where Chris Lorry's Krupp and I differ. They like to see all that stuff. I know what I'm looking for. I know when it ain't going to fill. I know when it's only going to go in there in a little bit, and that's the institutional order flow entry drill. I prove it because that's how I do my pyramid entries in. You don't get that anywhere else. Okay, I'm not trying to kick sand in his face or anything, but I'm just reminding folks who's who and who you're listening to. It's just confidence and authorship. It's not arrogance. It sounds like it, but it's not. But having that graded price run, it allows you to plan. It allows you to expect and anticipate new entry patterns. And you may not have the equity or the experience to go in pyramid. Like if I go and I buy 6 contracts, the next wave of me entering is going to be 3. And the next one would be 1. Or if I go in with 8, I'll go in with 8 with the first entry. And when it moves in my favor a little bit, then I'll go in with 4 contracts, half of the initial one. And then the next wave will be 2. And then if I get another piece on, it'll be 1. So I'm building in those positions. I was doing that on Twitter years ago with a demo account, made it public, and I literally ran up every single trade I took on a 15-second, 1-minute chart, and a 5-minute chart. I was trading both sides of the directions, and I was trading 4.5%, sometimes 5% on the trades. Every single pyramid entry, I was using 5% max every single time I was doing it. And that's how I took the 5,000 and the 100,000 counts over to several $million. I did that very thing over and over and over and over again. And as the equity increases in the demo account, you get more equity used. And that's all that was. And I am absolutely fucking ready to do that same thing in Robbins if Benny E. Mini proves he's in the fucking Robbins Cup and shows his account number, because I'm going to roast your fucking ass, bitch. So the last thing, obviously, is market making principles. So market making principles are simply like time of day. When is there an intraday influence? When do things that normally occur, like market protraction, like Judas swings? Let's go back to understanding the market structure and the shifts quarterly. Okay. If you are looking for a way to systematically reduce everything down to a nuts and bolts, this is how I do things, this is how I follow this process, I'm not going to do anything outside of these rule-based ideas, this is what you are trying to do. You want to do this with your trading plan. Between April, May, down into June, you really want to be focusing on going short stock indices. The bigger moves, the cleaner moves are going to be on the sell side. Going long in the fall, going into they call it the Santa Claus rally, the Christmas rally. The market tends to create a little bit of a flurry run up higher going into the close of December. Now, with all the things going on in the world today, that's probably an invitation for it to not pan out this year. And if it does, don't let it be a discouragement, because I want you to go back through as many years as you got data to go back and look at it, and you'll see it's there. It's there. It repeats. It repeats. It repeats. Okay. So doesn't it make sense for you to be focusing on one side of the marketplace where there's the tendency for it to move in greater magnitude, one direction, and lean only in that direction for your bias and narrative ideas for taking trades? Right away, you have filtered 80% of the bullshit that most traders fall victim to. You're not going to push it hard in the summertime because it's the doldrums. Now, there's opportunities to do that, but you're not going to be pushing your highest leverage. You don't want to do that because there's a likelihood of it becoming choppy and messy. So time of day, you want to be focusing on, if you're, say you're in the sell model, in the spring highs that go down to the summer doldrum lows, leading into the fall months low that starts to rally up into the close of the year. During the spring fall time period, I shouldn't say it like that. In the spring declining or sell model, where it's likely to go lower on the daily chart and continuously drop lower, if you look at time of day, you can start studying and see that the London Open between 2 o'clock and 4 o'clock in the morning Eastern Standard Time, you will have a 70% likelihood of seeing the high of the day form. What will it look like? It will look just like that fucking model I gave for free on YouTube. You're going to wait for some buy-side liquidity to be taken. Then there's a shift in market structure. Wait for the fair value gap to form. Sell short in the fair value gap. Hold it. Minimum. Hold it minimum to New York Open. And then see if New York gives you a continuation where you can go in and maybe pyramid. That's a goal for you to do. Not go out there and start doing it right now. It's just something you grow into. That's where you have to have a model right now you work on. But what is your end objective? What are you really trying to do as a trader? I want to sell short the highs in the London session or buy long the lows in the London session and hold for the daily range. That's day trading. If you're doing anything less than holding for the daily range, you are intraday scalping. That's it. Now you can break that down into session swing trading, where you're swinging the entire New York session or the London session and getting out before 5 o'clock in the morning Eastern time. There's nothing wrong with that if that's your model, if that's what you want to do. And you don't want to do anything else because time of day and schedule, school, business, your family life, you just don't want to be in front of the charts a lot of times. You can make a career just by doing session only. 2 o'clock in the morning to 5 o'clock in the morning. There's your 3 hours. That's it. You're done. Or work the 8:30 to 11 o'clock morning session in equities and be done. Don't trade the afternoon. Or trade 1:30 to 4 as your PM session. If that's what you want to be doing, and that's the time that fits your window of opportunity, then there it is. The question's going to be, what can I do, ICT, if I can't do any of them? I don't know personally. Like, I don't know how to answer that because I don't fuck with Asia. It's very far and few between opportunities that form in Asia that I like. I just don't like it. Doesn't mean you can't find an opportunity there. I don't have the confidence as a mentor to say you should do that. Okay. You want to be in the highest order flow volume that's coming into the marketplace, which is London and New York session, and in the afternoon session too in New York. So those 3 time periods are kind of like your the 3 best times of when you want to be trading and why you should be doing it. So if you're using the time of day idea coupled with that sell model in the spring months going down in the summer months in stock indices, the ranges will be gravitating going lower. Now, not every single candle in the daily chart is going to be a down close. And that's another thing that neophytes do. They come in here and they think every candle is going to be a down close. But I thought it was the bearish bias was going to, you have to have other things, folks. And market profiles. Now, before I get any further with this one, I am not talking about market profile, where they do the little volume histogram, on its side axis, and they look for, point of control and all that stuff. That to me, no offense, corpse, but that's bullshit stuff to me. Like, I don't think there's any reason for anybody to do that stuff. But if you're making money with it, God bless you. I'm not here to detract or say anybody that's making money with it can't make money with it going forward. I'm just saying I don't personally subscribe to that, and I already know what your volume profile shit's going to say to you before you see it. So, market profiles. I have weekly profiles that I use, and I use daily profiles. So what is that? I'm looking at the tendency for the market to do certain types of delivery. It'll make the high of the day in London and go in consolidation the rest of the day in the New York session.